Alright guys, my name is Shervin. Welcome to my channel. In this video, we're going to talk about the 5 most common mistakes beginners make when investing and why it is so important that you avoid making these mistakes. Now, when it comes to investing, there are specific disciplines that are very important to have in order to make sure you can grow your investments steadily and lower your risk of ruin as much as possible. Because at the end of the day, we all want to make money from our investments and none of us want to lose all that we have. So it's very important that we do these things in order to make sure we keep on the right path. So if you watch till the end of this video, I'm going to walk you through what these common mistakes are, what habits you can build into your investment strategies in order to avoid making these mistakes, and why it is so important that you keep these habits up for maximum return over a long period of time. So let's get right into it. And the first and probably the biggest mistake beginners make when investing is that they invest into something that they don't understand. Now, it's very important that anytime you're investing into anything, you first do your due diligence and fully research what it is that you're investing into. You want to know everything about that specific company or that specific stock or that specific bond. You want to know if it's a good investment or not, how much risk is associated with it, if the rewards are worth the risk that you're taking on. And it really doesn't matter who you heard about this stock or this bond or this option from. It's very important that you do your research regardless of how many people are buying it or how many people are recommending it. Because guess what? At the end of the day, you're the one putting your money on the line. Like if I recommend something to you and you go and invest into it, if your investment doesn't turn out well, I'm not going to lose anything, right? You're the one losing your money. So it's very important, no matter who's recommending what option, what stock, what bond, no matter who's recommending this investment, that investment, it's very important that you always first go and research, make sure that it's a good investment and it's a right fit for the kind of risks that you want to take with your investments, and then go ahead and invest into it. Now, I know this might sound kind of obvious, but you would be shocked at how many people don't even do an ounce of research before investing into something. They just hear about this specific investment from a friend or a family member or maybe a YouTuber, maybe they read it on a blog somewhere, and they just go, okay, let's just go invest into that thing. Now, it's completely fine to hear suggestions from other people you know and trust. It's completely fine to hear suggestions from friends, family members, from YouTubers you watch and trust, from bloggers you follow and what have you, because that kind of gives you a starting point. You kind of see what other people are investing in, what other people are interested in, and then you can start your research from there and see if any of those are worth it for you or not. But you gotta do your own research. You can't just blindly invest into something that you know nothing about just because other people are also investing into it. Now, the second mistake that I see a lot is having too many short-term or high-risk investments in your portfolio. Now, it's very important to make sure the majority of your investments are into safe and long-term investments, because this protects you against ruin. This protects you against losing all that you own should anything go wrong in the market. So when it comes to risky penny stocks or obscure cryptocurrencies or any other types of high risk, high reward investments, you want to make sure to stay away from them as much as possible, because these investments could end up losing you everything at a moment's notice without any prior notice. It's true that they could go up massively, but at the same time, they carry the same risk where at any second they could just crash all the way down and lose you everything. So just make sure to keep these below 5% of your entire net worth. I would recommend just staying away from them entirely, but if you really want to make these investments, just keep them minimal, keep it 5% or less of your entire portfolio, and just be careful. Now, the third mistake that most beginners make is not smashing that subscribe button down below and joining the family. On a serious note though, if you're enjoying this video, I'm making new videos like this where I talk about investments, banking, personal finance, all the time. And if you subscribe to the channel, you get to see all those videos right as they come out. Also, every subscriber makes a big difference for me, and I really appreciate your support. But with that said, let's get back into the third mistake that most investors make, and that is panic selling. Now, panic selling refers to when you sell your assets when they are going down in value out of fear that they will keep going down in value and never recover. Now, if you're following the first two tips that we talked about, where you know exactly what you're investing into, and you're investing mostly into safe and long-term investments, then you should never ever panic sell. No matter how hard the market crashes, no matter how much your investments come down, you should not panic sell what you have, because the markets always recover. No matter how hard the market crashes, they always recover within a couple of years. So if you're investing for a long term, if you're investing for the next 20, 30 years of your life, you should never ever panic sell, because guess what? They're going to recover. All your holdings will recover in a couple of years. And in a 20, 30 year span of investments, it really doesn't matter if for a couple of years your investments went down and then came back up. it's negligible. It really doesn't matter. All that matters is that over the next 20 or 30 years, your investments trend upwards. And that is the case with the market. And as long as you're picking safe and durable options that will sustain over a long period of time, you should be fine. So you should not panic sell what you have, no matter how hard the market crashes. The next mistake I see, and this is a super common one, is trying to time the market, meaning trying to buy at the very lowest point and trying to sell at the very highest point. Now, the problem with this is that you can actually never really time the market, at least not perfectly, because you never know when the stock is going to go up or down or in circles. Professionals get paid tons of money to try and guess, and even they are not able to always time the market perfectly. So you are not going to be able to time the market perfectly either. In fact, even if you could time the market perfectly, you still shouldn't do it, because there's been a lot of research done on this. And what was found was that over a long period of time, let's say a span of 30 years of investing consistently into the S&P 500, you would actually be better off spending the same amount of money every single month investing into the S&P 500 than if you just saved up your money and invested at the lowest point of the market. Because when you just saved up and invested at the lowest possible point, you actually ended up missing on all the times when the stock was consistently going up. So the person that was investing consistently every single month, regardless of the price, this is also known as the dollar cost averaging, they actually ended up with a lot more at the end of the 30 years than the person that was timing the market perfectly. So even if you could time the market perfectly, which you can't, you would still be better off not doing it and investing just every single month on a consistent basis, because this way you're always averaging the cost that you're putting into the stock, and this way you always guarantee a trend upwards, and you actually end up reaping more rewards than the person who's trying to time the market. Now, last but not least, the fifth mistake that beginners make when investing is not diversifying their portfolio enough. Essentially, it's very important not to put all your eggs in one basket and just spread your wealth into different investments in order to safeguard yourself against losses and minimize your risk of ruin. Essentially, just spread it around, make sure you have different types of investments, different assets in different asset classes, in order to make sure if one of them is not doing that great, another one can do just as well and pick up your entire portfolio. Make sure you're always trending upwards with your investments. Now, I will be making a full video on what professionals recommend you do when it comes to diversifying your portfolio and what kinds of strategies you want to use in order to minimize your risk as well as maximize your gains. So stay tuned for that video if you're interested. So those were the 5 most common mistakes I've seen when it comes to investing. If there are any other ones that you think I may have missed, make sure to let me know in the comment sections down below. Also, if you have any questions about any of the stuff that we talked about today, make sure to also let me know in the comment sections down below. I always respond to every single question that comes in. And with that said, hopefully you guys enjoyed this video, and I will see you in the next one. Cheers.